let me just do a real quick, we'll go through and ask everybody to introduce themselves, and then I'll give a little bit of an introduction and we'll get rolling. So David, I want to start with you.
Sure. Hi, David Klein, CEO and co-founder of a company called Common Bond. Common Bond is a marketplace lending platform that to date has exclusively focused on student loan debt. Specifically, we lower the cost of student loan debt for borrowers while at the same time provide competitive financial returns to investors on our platform relative to the underlying risk that they are taking on. A couple quick hits on that and a couple other things. Due to our upfront underwriting and ongoing risk management processes, in the 2 years we've been at national scale, we've yet to experience a default. In fact, we've yet to experience even a 30-plus day delinquency. We surpassed 100 million loans funded last year. We'll surpass about 500 million loans funded this year and expect to surpass about 1.5 billion by the end of next year. We're a team of 40 people based here in New York in Chinatown. We hope to make that about 60 in about 3 months and then double that again next year. I'll pause there and look forward to the discussion.
Thank you very much. Joe?
Joe Proto, I guess I'm the payment geek at the table, the payment plumber at the table. Sold first company to Wells Fargo in '92. I know that was probably before many of you were even starting college. Sold second company to First Data in 2000. Left right as KKR was coming in and started third company. Transactus electronic billing and payment, disrupting the payment space through big banks as opposed to against them, with a wife who says, "Don't screw this third one up."
Excellent. Omar?
Hey, how are you? My name's Omar. I am the co-founder and CEO of Abacus. Abacus is replacing the expense report with the first real-time employee expense system, so hopefully no one's too attached to their expense reports. Prior to that, I basically spent the last decade in the FinTech space, more on the growth equity side, but look forward to the discussion.
Okay.
Hi, I'm Pete Casella, Executive Director of Strategic Investments for JP Morgan. So we're effectively the firm's corporate venture capital group, and we work with all the various different businesses that we have at JP Morgan Chase to identify emerging technologies that are relevant to solving either our problems or our clients' problems, and then find opportunities to partner with the startups, bring them in, consummate a commercial relationship, partnership to go to market, and hopefully in the process bring the franchise behind the companies and create equity value for the founders and also some equity returns for us as well as solving some problems.
Hey everyone, I'm Charles Birnbaum. I'm an investor with Bessemer Venture Partners, kind of a classic venture capital firm that's been around for a long time, and I help lead our financial services and financial technology practice. We have a pretty broad portfolio in the space, Betterment being one example of a company we've backed for a number of years since the very early days. We're also investors in Abacus, so I won't be throwing any softballs his way, I can assure you. And prior to joining Bessemer 2.5 years ago, I was an early employee at Foursquare, the mobile application company here in New York, where I had various product and business development roles over the years. And prior to going to business school, I was a Wall Street investment banker for 5 or 6 years. I consider myself a recovering investment banker. I feel like there should be some sort of AA group for us. But bring those two experiences together in my role to work with entrepreneurs at Bessemer and excited to be here today.
That's great. So, as we talked about with John earlier, FinTech actually has a pretty broad definition, and it's a challenge when you have a panel like this. We've got some B2C, lenders. We've got some plumbing, as you said, payment providers. Definitely B2B. Got a couple of investors who have invested both on B2C and B2B side. Omar is it's a B2B play because it's helping with expense reports, but at the end of the day, it only works if the consumers like it and it works well for the employees. And so, I think that as we look at this space, one of the first questions is, what's the sort of fundamental part of the definition? I started off with a definition of companies trying to disrupt finance, and Pete said, "Wait a second." He implied out of that there was new company, it was a new area. And like he said, I've been doing FinTech for 15 years, and not to mention the fact, and Pete was the one who said, talking about JP Morgan. about how much money is being spent on the underlying plumbing aspect of things. I mean, we do hear a lot. There's a lot of press right now. I think that there's probably a fair amount of hype in some areas in terms of talking about more of the consumer-focused area. And so I want to make sure if people have questions in particular about more of the infrastructure stuff, that we spend a little bit of time on that, because I think that's an important piece of it. And something that, in talking to John, look at what's going to enable them to become a big company. It really is their full stack platform, as he puts it, laying out all of the plumbing that's required to deal with this. And so, love to have some conversations about that. We're going to try to have a little bit of a free flowing panel here. I'm not going to just go down and ask them each a question. We'll start a conversation, and I've asked them all to react to each other, and once I sort of start the thing going. So, I'm actually going to start with Pete. What makes fintech hard as a company starting it, and as an investor looking at it?
So I think it's not an investor in a company, but I would think of it as the bank and the startups that we're seeing. I mean, at the end of the day, this is people's money, right? And so the hardest thing to establish in this market is trust. The banks have spent 150 years building trust, and we don't want to lose it. And the startups don't have the trust of the clients yet to give somebody that's on an iPhone their money. And so how do they earn the trust? And so I think what we're doing is we're trying to spend our time finding technologies that move the client experience forward, that change the way we interact with our customers, make everything better, but don't jeopardize the trust that we've built with them. And I think for the startups, they're doing whatever they can to build the credibility to justify people depositing that first $1,000 in the account. And so I think that leads into the question of risk tolerance and everything else, which is obviously a big issue where the banks, we just can't get it wrong. Like if we give something to a customer, it's got to work. And whether that's an institutional customer like a pension fund or a hedge fund, or whether that's a retail customer that has a credit card with us, everything needs to work. And so for us, the hardest thing is figuring out where this innovation intersects with our business priorities and how we can bring the trust and credibility and client base that we've established over the last 150 years, and yet continue to innovate and push the envelope around customer experience and innovation and efficiency.
So Omar, how do you deal with that trust issue as you come in, right? Because you are in fact the app that people are trusting their money to.
Yeah, absolutely. It's funny because when people love to talk about disruption in payments, they love to talk about innovation in payments, and I think it's sexy to talk about. But in reality, if you think about where the pain points actually are in payments, it's not really at the plumbing level. It's not really at the infrastructure level. I mean, it's a hassle to work with when we want to integrate all the ACH systems and the corporate card systems and things like that. It's not pretty, but I feel like the pain point is something that is actually more at the the workflow level, how you interact with those payments. And so just to kind of build on this trust point, we work with the existing banks. We work with guys like Wells Fargo or Chase or, the existing, banks that are, handling the plumbing aspect because, dealing with all of the stuff that you would want a utility to deal with between security and trust, that's not the stuff that you can move fast with, and that's not the stuff that, in our view at least, is what's really broken. The part that's broken is how you interact with that.
So Charles, when you guys are looking at this, how do you assess, if you're doing your job right, you're probably investing in companies early enough for them to actually build these customer relationships. What do you see as you're looking at companies that would let you say, okay, this team actually is likely to be able to build trust with people. They have an idea that's worth funding. What are the big issues that you're seeing?
Yeah, I mean, part of it comes back to the question earlier. Who's starting the company? What kind of DNA does that founding team have? Is it from the financial services industry? Do they have the real experience to know how hard it's going to be, how long it's going to take? The one thing that's consistent across financial technology, I think maybe alternative lending has a little bit of a different flavor to it, is things take time. I mean, we invested in Betterment 5 years ago when John was just getting started. They had a couple million in AUM. 5 years later, company's hitting its stride, and that's pretty much as fast as they could have gone. Team executed incredibly well, has been as lean as they could be, but things take time, and part of that is building trust. they're starting from scratch. And I think you sit across the table from entrepreneurs, and I think if somebody thinks it's going to be quick and puts a plan in front of you that is not credible, I think that's where the disconnect comes, and it's hard to overcome. So I think that things take time. Assets are sticky. It's hard to leave platforms like J.P. Morgan and Merrill Lynch in the wealth management example. But then once you do acquire those customers, they're sticky again.
I will eventually get down to you, David, on the lending side, because there's a whole other world right there that we're doing right now. But let me ask Joe first, because as you said, you've done this a couple times before. So I imagine one way to build trust is that if you can show that you've actually done it before, that people understand that you know how you're going about it. Who are you selling to, and how long did it take you to get to the point of, once you started the company, of getting your first sale, and then what happened after that?
So nothing happens in the traditional payment and banking space quick, right? We all know that it's glacial for the most part, but the common theme here is that there's change happening in our marketplace, and we've encountered what that change is and said, what are we going to do to disrupt it? In my case, having a long career in the business, I went to the banking execs and said, what is so broken that you can't figure out how to do on your own without a technology provider like me? Because that's what I'm going to go build. So I went to the big banks, and they said, we think that the largest billers can do electronic billing and payment really well, but the other 4.2 million billers cannot. And they're going to come to their bank and look to us to solve it for them. We're the trusted provider. They're going to come to us. We've tried and failed. If you have it in you, go for it. And so
let me stop you. So when you say the other biller, the 4.4 million billers, small business?
Medium, large. Our customers include United Healthcare, Duke Energy, Fortune 100 companies, but they don't have one billing system. They might have one for their consumers and one for their businesses, but then they've got a dozen or 24 other systems out there that they do billing and payment around. So if you find a big addressable market that nobody else has figured out how to crack the code, and it's all disaggregating. Nobody has that model that says, I can go to my bank, I can get a solution, I don't care who provides it, somebody did the chip for Intel inside. That's a winning combination. I give a lot of the companies who've gone head-to-head in the space direct for B2C a lot of credit. For me, I take the easy way. It only takes about 10 years to go the easy way, by the way, Chris. And I hook myself to the big banks.
And one of the things I liked that when we talked before the panel, when you mentioned that you got tired of moving molecules around, you wanted to move electrons, right? So there's an element here with a lot of these things that we're talking about that. We talk about the consumerization of IT is one way of thinking about it, or the, moving electrons instead of paper. Instead of sending out paper bills, how do you get people onto an electronic billing system and payment? And even now, there's lots of little things that I do. The lawn guys, right? I do electronic payment, but guess what? They write a check and they send the check to the person 5 to 7 days later. And so, why shouldn't they be in a position where they can set up they can set it up so they can receive and be part of a database for electronic payments? In terms of thinking about this, though, what are you finding in terms of how people are reacting to your technology? Are you integrating within? Are you a separate standalone technology play, or are you just sort of behind some other payment system? Will I see you? Will I see Transactus, or is it
never?
Embedded?
You'll never see our brand as a customer. The bank brand is also subservient. It's really your corporate biller relationship that's paramount. The multi-billion-dollar problem that's waiting to be solved is right now we have an omni-channel experience. There's some paper in our lives. There's some bank bill pay. There's some biller direct. None of that is aggregated completely. Now, I know the millennials in the room, they don't even check their mailbox. But for the most part, billing and payment is still very, very multi-channel. And if we can bring that together, and there are initiatives that are being worked on today, in combination with the financial institutions and the big disruptors like the Googles, where I think we're right on the precipice of turning that corner for the payment space that will change it seismically.
All right, David, I'll come down to you now. Now, we now know that you can make sure you send electronic bills to people and everything else. Tell me a little bit about what you're doing. There's obviously the marketplace lending area is one that has had a lot of traction. On Deck has done a good job. The marketplace lenders go across a whole bunch of different areas. They seem to be focused on sort of different niches, whether it be small business lending or for you, consumer loans, and in some cases, more replacing payday loans and things like that. Talk to me about how you got into what you're doing. And as an aside, it's actually interesting to me talking to David because I first met him 2 years ago, 18 months ago. 18 months, 2 years ago?
Even more, yeah.
And there's an outfit in New York called House of Genius where they have you sort of sit around a table and have dinner and people and get feedback on something. And you were really pretty early on in the process of things. I mean, you had a very definite vision for what you wanted to do, but to be already at over $1 billion in loans, what did you say your current loan volume was?
We'll cross $500 million by the end of the year.
So at $500 million in loans already with no defaults, obviously you've grown rather fast. So what made you decide to focus on student loans? And as you look out, what are the biggest challenges that you have? Because you are a consumer-facing business. There's a lot of marketing required out there, I would presume.
Mm-hmm.
How are you approaching this?
Yep. Just a word on trust. And then a word on the question you just asked, which is what makes it difficult, and then your other question around how we got started. And I'll try and put that all together really fast, and I'll try not to be controversial, although I think what I have to say around trust might be controversial on the panel. So I think that, and I've never met Pete. We've just met now, but I hope we become fast friends regardless of what I say. Sure. Okay. So I think one of the when I think about trust, when I think about finance, I think the reason that we get to exist as a marketplace lender is precisely because a lot of people have lost a lot of trust in traditional banks, and most of that is pegged right to the crisis. In fact, there's a lot of data that shows trust among banks was something in the 60%. Post-crisis, it was then in the 30s. And it's because of that, and I wouldn't say that trust has been completely lost among banks. And I do think, admittedly, that some of what I just said is even given more credit than what is real. I have a Chase account. I trust that when I go to my ATM, it's going to be there. I think a lot of other people believe that too. So I think what you're saying is true. I think also what I'm saying is true. And I think the thread of the needle between those two things is that people now, post-crisis, are much more open to alternative forms of finance. There's no way we'd be able to exist, or the entire marketplace lending industry would exist, had the financial crisis not happened, had trust not been lost to a certain respect among traditional players, and people's and governments, by the way, minds have been open to traditional forms of finance. So that's my piece on trust. In terms of what makes fintech hard, from our perspective, we lend money, or at least we're a platform that facilitates the lending of money. It is a capital-intensive business, and it is a complex regulatory environment. And as you talk to a number of different entrepreneurs, what they'll tell you is that they generally like to take the path of least resistance and de-risk propositions as much as possible so they can reach a level of scale as quickly as they can. If that's the mindset of an entrepreneur, you're not necessarily going to choose a path where capital intensity is higher than in any other industry. In order to launch, you basically need to bring $100 million or more onto your platform. In order to launch, you need to pay a lot of money to lawyers to figure out a number of different things and then structure those funds for you. It's not exactly building an app. There are a lot of things that need to get done. It requires a huge leap of faith and a lot of money. So I think that's one of the things that makes fintech hard. The final thing I'd say, just so you guys have a sense of how to position all of us in your minds, I'll oversimplify it by saying finance or fintech in general is basically, if you think about your own personal balance sheet, you have a set of liabilities, i.e. debt in some capacity. You might have a mortgage, you might have a credit card, you might have student loans. That's your credit side. You then have your assets, which companies like Betterment help you manage. And then for the flow of funds, whether those funds come from a debt form of financing or an asset form of financing that you yourselves likely have, the flow of funds need to be connected to different parties somehow, and that's what the rest of the folks do in the payment space, right?
When you talk about both sides of the balance sheet, I think the trust equation is quite different. Because when you're giving people money or selling money for a living, right? I mean, I think there's a lower barrier that you have to cross to let someone take the money from you, versus in the asset management space, even in the insurance space, which none of us are directly involved with. But I think that's another interesting theme there. You're taking someone's money and they're trusting that at some point later you're going to give it back to them and do right by them. So I do think there are some larger hurdles in other elements of fintech. And I think alternative lending, one of the reasons a SoFi, a Common Bond, an Earnest, some of these companies have gotten, Zopa, one of our companies, have gotten off the ground so quickly and can get big in 2-3 years is because of that.
I also think, I mean, one of the things, and I asked John about this in terms of the market downturn just over the last couple of weeks, or the last couple of months, but there's a bigger issue, and one of the things I'm hearing on marketplace lending is, but they haven't been tested yet by a real sustained credit crunch.
But they have, by the way. Lending Club and On Deck were in existence and Prosper were in existence in 05, 06, and 07. So it's a bit of a misnomer, that concept. I'll let you finish, but that's...
No, it's okay. We might have covered that in some due diligence conversations when we were dealing with On Deck and asking about that. But I think that there's still, the fact of the matter is that debt is very cheap right now, which also facilitates this. Now, there's all sorts of ways that you can mitigate, and you could say technology helps you mitigate, right? If you look at the small business lenders, what are they doing? They're getting access to the small business bank account data, just like John said that they do. That so he's sweeping assets out. If people have investable assets, the small business lenders can keep an eye on the cash flow of the customers at a much more granular and real time basis than historic banks, right? So that is a clear difference where technology and APIs giving easy access, together with the data mining ability and analysis, helps. When you're looking at this, then, Pete, as you're looking at the different people who are trying to deal with all of these different things, what are you seeing in terms of, if somebody were to ask you the question that Joe went and asked, which is, what are the big problems that you're trying to solve right now that aren't being solved? From the bank's perspective, what are the things that are out there that people are just starting to get at that you think are particularly interesting?
Yeah, I mean, I think that there's always going to be massive plumbing issues that probably most people in this room don't even realize exist. And so if you think about the biggest, hairiest problems that we're trying to solve as a bank, it's a lot of stuff that this audience probably doesn't even realize is a problem. And whether that's regulatory reporting or collateral management or settlement and clearing or really unsexy stuff, that's probably the biggest, hairiest thing that we're trying to solve for. I mean, I think what we're also trying to think about is, as digital technologies reduce the amount of friction in client acquisition, how can we partner and leverage that experience to make it easier for us to lend money or gather assets? And I think, if you look at the marketplace lending folks, I mean, one of the best parts of that experience is you can go on, you can apply for a loan, you can get the money in 12 hours or whatever it is, and it's in your bank account. It's like, I got $20,000 at 5% interest, and I got it by lunchtime. That's pretty awesome. Like, come to Chase and ask for $20,000, and it'll take you like 2 weeks, right? If, we talked about paperwork before on this. And so I think for us, we're trying to solve interface issues. We're trying to solve client experience issues. Those will continue to happen, but the biggest, hairiest problems that we're solving tend to be things that most people don't realize exist.
I mean, it is interesting. And so do you think that startups are solving those problems? Because
for the most part, no.
I mean, this is actually one of the things. I think some of those problems are actually, there's huge companies. And actually
there will always be startups that are solving these problems, but I'd say for a lot of these problems, they get solved by marketplace participation. And so what will happen is we'll identify a problem, and it'll usually be an ex-practitioner that was sitting in a job someplace in a bank and said, this thing really sucks. I wish this worked better. And they quit their job, and they're the finance person that goes and hires the IT people, and they figure out how to solve the problem, and they come back to their former boss, and they say, I think I solved that problem that we couldn't solve. But the only way that we're actually going to solve that as an industry is if we get 4 or 5 other like-minded banks around the table that say, okay, you have this problem too, and I have this problem too. It's messaging, it's KYC onboarding or something like that. We all get together and we solve it as a group. And so at the core of it, there's always a startup. There's always a management team that has equity and that's going out and trying to build franchise value. But I think the way that those things work is by getting sort of a group of people around it. And those are the things that I think most people in this audience will not
And those are
represent.
tough companies to fund.
It's for pure financial investor.
Talk about that for a minute.
For a
about why
pure
they're
financial investor, for sure, because we're going to get a lot more strategic benefit out of that solution. So for us, the equity returns are nice, but it's not the reason that we're doing it. Whereas a venture capitalist needs to make all of their money in financial returns. And so,
Yeah, so it's interesting. You talk about the infrastructure of financial services, and as venture capitalists, we're supposed to think big and try and find the most disruptive things we can. But what's interesting in financial services, the most disruptive things, the guts that you guys look at, really hard businesses to fund from scratch and start up without the help of the existing financial institutions. And as long as it will take to build an asset management company or an alternative lender, it's that much more difficult to fix the guts of these systems. Many have tried. You can have modest success. And I think a lot of times those entrepreneurs, for the entrepreneurs in the room that are trying to do that, you can have a great outcome for you, your team, your investors, but I think you have to capitalize your business appropriately if you're going after that challenge. And then there are some that are trying to build that layer for others like Abacus and Common Bond to build upon. The Yodelees were the first V1 of that. Now there's companies like Plaid and Quovo and a lot of interesting companies out there that are trying to do that, but they still have to work within the existing systems that the banks hand them.
So I mean, that's actually a very interesting theme, because I think that that combination of it takes a long time, and you can have a nice return. When you say appropriately capitalized, you're basically saying not too much capital in, so that when you get a $10 million, I've often told clients that, look, if it's you and two friends and you've worked for a year and you get paid $10 million, that's a pretty good deal, right? That's enough that could be life changing for people in terms of doing things. It's not going to make the venture capitalists get up in the morning, and so the fact of the matter is they're going to want to write a $3 million check to begin with, which automatically then moves you to a $20 to $30 million exit being anywhere close to interesting. So I think that's interesting. It goes going back to that tech talent question that we talked about with John. What is harder right now? And in New York, I actually do think it is tech talent. But Omar, let me ask you this question. Let me ask about, in terms of building a team to do this. I don't know that having Harvard-trained economics students coding is probably the way to build most companies. John did a good job with it, but what are you seeing in terms of building this? Because you're doing a pretty hard set of things as well in terms of the integration with all the different payment systems.
Yeah, and even despite the fact that you have all of these regulatory issues you run into, all of these kind of tough old systems that you're kind of dealing with, then ultimately, in order to get that all to come together, the makeup and chemistry of the team in the first place, in my view, really has to be kind of tech first. And I think it's much easier to kind of start off with a very solid team of engineers and designers and start building almost from like a culture perspective. It's much easier to start building that culture and then attract the other people who want to be part of that than it is to build the other type of culture of people who are interested in like regulatory or finance and things like that, and then attract talented designers and developers too.
But Omar, let me ask, there's a difference between, I think, the initial team when you're first launching a company and hiring the engineers to execute it versus the person who actually understands the problem. Mm-hmm. And generally speaking, the people who understand the problem are people who have lived the problem. And so more often than not in this space, they tend to be somebody who saw something and said, you know what, this should work differently. I think coming out of Silicon Valley, you have a lot of people say, I wish I could deposit my money this way, and it's on their phone, and they're saying, let me go hire a bunch of engineers and build something that works this way, and hopefully it'll become ubiquitous. But for a lot of fintech, you're trying to solve an industry problem, and it's very hard as an outsider to understand what the industry problem actually is unless you've lived the problem.
Well, just to kind of counter that, I would say that the one thing with fintech is it's such a broad word that a lot of the problems and pain points that are being experienced are in the fintech side of it. And so unless you have that engineering background, it's almost like you can't even necessarily understand some of the pain points or have a creative solution to fix that. And so, from our perspective, having that right mix of, an engineer, someone who's been in fintech. I think there is an ideal combination of people, but I think having at least like one engineer as part of that core team is really important. Yeah.
Joe?
I have a very definite experience here, an opinion. When I did this company, we started with 3 guys and a goat. The 3 guys were tech guys, and the goat turned out to be the best one in the group. I'd come in the morning, guys would work all night long and say, Joe, isn't this cool? And I'd go, this is crap. We serve Wells Fargo and PNC and Capital One and TD. There's no way this is going to work within a typical major financial institution. So I had to gut that and start over, right? And started with product experts who then brought technology people in who said, now here's where we want to get to. Build this to support that. So I would agree that the tech talent in New York is very hard to find, but now we're 75 people, so we're past that stage. But fintech is financial technology, even in its broadest spectrum, is not for the faint of heart. There's no one who's made it in fintech that doesn't have lots of scars.
I would also say one quick thing, which is I feel like a lot of existing fintech companies and banks, they have very like focused engineers, but there is this concept of like full stack engineers, the ones who not only have a product sense and a front end ability, but also the back end. And I feel like the future really innovative companies are going to have people like that as part of that core team.
I do think it's interesting in terms of thinking about what problem you're trying to solve, to understand when again, as each of you think about the problem you're solving, it's not just a narrow problem. If you start in one area, that on the tech side, you're looking at a broader problem. Let me ask you that, David, from your perspective.
Yeah. Those two things actually dovetail quite nicely, tech and starting in one space and then growing into the next. So when we think about technology internally, we think about our developers as the builders of the organization. The more developers we have, the faster we're able to run, the faster we're able to introduce more products than just student loans. So student loans is where we started, but it's not where we're going to stop. In fact, in 2016, we'll be launching another asset class altogether. It's likely going to be personal loans and offering personal credit to many of our current student loan borrowers as they continue to evolve their financial needs over time. We'll also not stop at personal loans. We'll continue to build into other asset classes across finance. The more good tech folks we have on board, the more, the better, and the faster we can build to support the strategy of moving along the customer lifecycle with our customer, who right now on average is 32 years old. I think, as I had mentioned before, making about 6-figure income and has FICO north of 760. So when I think about growth from one particular niche into a broader market, it's tightly tied to how we think about tech and bringing tech talent in-house.
So I'll switch back over to Joe on this in terms of moving, and I think you might have a little bit of a counter view, because I kind of pushed this the other day when we were talking. He said, yeah, no, we're a payments company, and that's what we're doing. So do you think that there are some markets that are big enough that you can have a relatively narrow focus and stay there? Because my experience has been more along lines of what David's saying, which is that people are trying to expand the market as they go, or with products as they go along.
I'm probably the oldest person in the room, and they introduced me last month at some conference as the grandfather of payments. And I said, godfather of payments, not grandfather, for God's sakes. But I am a little bit contrarian. I think we're in a looser environment right now. Most everyone in the room, no one has seen a zero-rate environment for this long. No one has in our lifetime. We're looking at a time where compliance, regulatory control, security, all of those things that have been paramount for banking, which weigh very, very heavily on the financial institutions. It's not necessarily a level playing field for entrepreneurs right now. So if you can create an entrepreneurial environment through this and thread the needle during this period of time with very cheap money, lots of VC and private equity money around. Look, anything can get funded nowadays. I know you're laughing about before, Chris, about whether we're in a bubble or not. I mean, for gosh sakes, what hasn't been funded? My I know I'm jaded.
So those of you who haven't gotten funded yet,
Let him keep going. Let him keep going. This is great.
This is going to end in tears and scenes. There are going to be a lot of blowups. There are going to be a lot of 2-year companies that said, "Boy, I learned a lot while I spent that $25 million in venture capital," and it's all going to be wiped away. There is some value in regulatory control, compliance, security. And so for those, I think where I'm betting very heavily, I'm a prolific angel investor. I must have about 75 companies that I'm invested in through different funds myself that I've helped create. If you can balance and play in the regulatory environment where you have to be secure and be a disruptor, that to me is the winning.
So Charles, I'm going to ask you a question, and then again we'll open it up for questions here so people can weigh in. What are you seeing right now in terms of the valuation environment? How is it making you guys think about things? I'm sure every one of your investments is going to go on to a fantastic liquidity event, but are you starting to see hints of concern as you go along, sort of broadly?
Yeah, I mean, having this conversation since 2010, I try not to predict when this cycle will finish. I will say, I mean, I think the alternative lending space is a really interesting way to look at this question. It touches on the zero interest rate environment. I mean, every time we evaluate an opportunity in alternative lending on the whiteboard, I kind of have to have a separate section on when things normalize, what happens to XYZ business, when capital gets more expensive and the debt capital markets change, how does that impact this business? So, we sometimes I think are punished by being overly thoughtful. We actually haven't made an investment in alternative lending since Zopa, which was the first company in the space in many ways, in 2006. They planned to come to the U.S. before Lending Club and Prosper retreated back to the U.K. when they got shut down. And we've looked at every company under the sun in alternative lending, and so many great teams, so many explosive stories. I know Mike well. You mentioned him before. But I think we've just had a trouble crossing a trade because of the valuations that companies have achieved at each stage relative to where they were at that time. And I think maybe to put a finer point on it, I think over the last year or so, we've started to go a little bit earlier stage, which is our roots. We are a $1.5 billion fund, so we have to put a lot of money to work in our companies. And I think our best approach is pouring more into our winners. Betterment we invested in with a $3 million check 5 years ago. We're still the largest shareholders, as an example. And there's others within our portfolio. So I think we're reacting in ways where, perhaps valuations might still be too high in the early stages, but I think the growth stages, we've done less over the last few months. But within financial technology, I think touching on all these themes and tied to valuation, if there's a team that is wildly credible, has a really big vision, and a very pragmatic approach to how they're going to do it, we're willing to back them for 10 years. We have long-standing LPs. We have a long tradition, and I think in financial services, it's a real advantage for us because some people are coming and going, but firms that are willing to write large checks and are comfortable with some of these regulatory issues and are patient are the only ones that can invest in financial technology over time throughout different cycles. So I think that's how we're thinking about it. Across the firm, it's very different because we invest in space technology and healthcare and other things too. But that's the financial services.
Just to add a word, talk about alternative lending. I'd like to just address two things. The first is this idea of progression. So not all raises are created equal. If you raise significantly more than you probably should at a significantly higher value too early in your existence, you're going to likely run into a lot of problems, or put another way, your operational flexibility in what to do in good times and or in bad become heavily restricted because you have to pay your investors back a significant amount of money. If you ever do another round and the economy turns on you, you do a massive down round and that puts a massive stain on the company. And so this idea of progression, how much you raise with how much time in between each raise and what your valuation is at each of those times, is something that is probably one of the most important and least talked about ideas in capital raising. And so while
I agree.
While we can paint a broad brush around who's not getting funded today, which I'll come back to because that's my second point, we need to just be conscious of not just, wow, everyone's raising money, but what's the progression of these companies? At what valuation are they raising at? Is it reasonable or not? And I think that is the ultimate distinguisher in evaluating whether funding is crazy or not. It's not the existence of funding, it's the level of which funding is happening within what period of time. That's point one. Point two will be shorter. Point two is to Joe's point, who's not getting funding today? A lot of people are getting funding. I think that's true. I would just like to direct all of you to a wonderful report that Andreessen Horowitz put together on June 15th of 2015. If you Google it, it's a slide share, and it does a great job of walking you through a ton of data and paints an incredible story about how funding right now is hot, but it's nowhere near a bubble on a comparative data-driven basis. Not enough time here to walk through kind of the key themes, but definitely worth Googling. Andreessen Horowitz, June 15th, 2015. Are we in a bubble? It should be the first thing that pops up. It's worth 30 minutes of processing time.
Yeah, I think that's definitely true, that there are different areas. And actually, the interesting part is that the plumbing type things are the ones that are least likely to be overheated. The ones that are overheated are the ones that have a lot of buzz. When we hear...
Well, Chris, often it's tied to market size. So
tied to market size.
When we and any of our counterparts look at investment opportunity, the easiest way to get loose with valuation is unlimited market size. And some of these markets we're talking about are quite large. Right. They're dominated by big players, but it's very easy to convince yourself that there's an endless opportunity in financial services.
Why then we hear that we have to grow into our valuation.
Exactly.
And I was going to say that one of the problems that this raises, which we don't have time to talk about here, but it's actually quite interesting in the markets that are hot, even if they're really, really, really fantastic markets. I'm a capital markets lawyer. Right? What I want people to do is go public, because I get paid a lot more to take people public than I do to do a financing round. I could do a huge financing round and it's $150,000 probably, and going public you can, it's 10 times that. So I'm all for going public. And one of the problems right now is that the public market valuations aren't equaling the private market valuations, and it shows up very heavily in the alternative lending space, where the public, the companies that have gotten public have had a tough time in the public markets, and the money coming into the alternative lending space at the later stage, in some cases is the public market investors, in some cases a crossover or hedge funds. It's very interesting that it's a fascinating time, I think, because I think that what's going to happen over the next couple of years, regardless of what the economy does, is quite uncertain.
And what's very interesting about financial technology companies and that disconnect, it's much harder to draw the straight lines for investors, especially ones that haven't been doing financial services for a long time. When you're investing in a private software as a service company that sells to B2B, there's a very direct B2B, correlation for what revenue and EBITDA multiples things are trading at. Here, people might be applying software multiples to a business like Lending Club that really is not a software business. I mean, Lending Club's actually probably a better example of a marketplace company than many in the alternative lending space, who are really specialty finance companies at their core. And when I look at an alternative lending business, I look at specialty finance multiples, book value multiples, free cash flow multiples. And that's not how private deals are really trading.
Right. And that's one of the issues, is that, and that's one of the places where it will end in tears. Joe's hypothesis, I think, it could very well be true. All right, questions from the audience. Yep, back in the back.
Question for David. I wonder if you could tell us a little bit about your thought process behind progressing to moving into personal loans as opposed to other asset classes as the next step.
Sure. So we start with the notion that the value that we're building is tied much less to a particular asset class we play in and much more to the borrower or the customer that we serve. And if our customer is about 30 years old, making about $100,000 a year and has really strong FICO, and we want to serve that customer over time, we start thinking about, well, what are the other financial needs that this customer may have over their lifetime? And personal loans is certainly, personal credit is part of that equation. Now, you could also argue it could be a mortgage, right? If you're 32, you might need a mortgage in a year or 2 or 3. And I think that's right. And I think that we should be well positioned to enter mortgages at the appropriate time as well. But as we think about staging and where to go next, we have to think about size of opportunity, unit economics, and operational complexity. And when we consider all of those 3 things, it makes a lot more sense for us to go to personal credit next. It's very similar, actually, by way of financial product to a student loan, much more similar to a student loan than a mortgages. So that was the thinking. That's been the thinking.
Question for Bessemer. Do you only consider the credibility of the team and the opportunity coming out of this space? And is it necessarily just fintech? Because Betterment is actually not truly fintech. It's more consumer finance based. And is it only for local opportunities, meaning US, or you're considering international ones too? For instance, you mentioned about a UK-based company as well.
Yeah, so we have an interesting approach that we don't really talk about that much, but we call it roadmap investing. A lot of other firms do this too, but I focus on financial services. And if there's an opportunity in the UK or in Germany or in California, me and a couple others will look at it at any stage, and we try and form theses around what's next. And what's interesting. John mentioned, what should I do with my money? We actually had pen to paper on a roadmap back in 2005, 2006, the what should I do with my money roadmap. There was no problem. There was no companies that were solving that problem for the consumer. Then we met John Stein. He had that concept, and we backed them quite early. And so we try and be thesis driven and then find the companies later. And if we come across a team that is credible, has an interesting approach, we'll do it at any stage because we're a pretty large fund.
Back in the back.
About funding and tiers. If you're a really savvy financial entrepreneur, and you have this idea for a financial app, what would you say don't do, stay away from, don't do it? I've heard personal financial management is done, don't even think about doing it, but what would you say and kind of why?
Well, I don't think everything's going to end in tears. There's a lot of great companies right now. All 3 of these are great companies, and I think it was Chris that said that. Yeah. But I think the one thing that, as an entrepreneur, the hardest thing about my job is meeting people all day, and we pass on most deals. There's only so much time and resources we have to put towards new companies. Might meet 800 companies this year, and I'll do 2 or 3 new investments. So when we say no, often it's not because it's not a phenomenal idea and that company or that entrepreneur shouldn't pursue it wholeheartedly. It just might not be a fit for the venture world at all, for Bessemer. There's a lot of different types of funds of shapes and sizes. I think the key, if you have a passion like John did back in the day or like these 3 guys did when they started, you should do it. You should just try and think about the best way to fund it appropriately so you own as much of it when the most likely outcome comes to pass. And when we enter into investment, we kind of think about it as a scenario analysis. I mean, how likely is it that that home run will be there? And how likely is it that that modest outcome will be there? And on a weighted average basis, does this make sense? You should think about it the same way for yourself and for your team. I worked at Foursquare for a long time where we raised a lot of money and needed to grow into our valuation later. That's painful for employees too. So I think the key is if there's a PFM solution, personal finance management app that you think has to exist in this world, don't let people tell you it shouldn't exist. Just finance it appropriately. So maybe you sell that for $20 million and had only raised 1 and you own half the company, and that's pretty awesome. There's nothing to scoff at either.
I would really just encourage you to not even really ask that question so much as asking. Just asking yourself if that's something you're really excited about. And if you can, what I always recommend to people is usually start with one person. Try to convince, one person that this particular thing that you're focused on is something that, that they would need, and it's some pain point. Try to really filter out that pain point that they have. And when I talk about this person, I mean like someone that you would want to work with on that project. Because if you can actually convince someone else to leave what they're doing, their other source of income, to come and work with you on something, then that's like a great kind of source of validation for you to start from and continue to kind of research from there.
I would add that the mobile wallet space is going to open up a whole new field, very fertile field for apps again.
The last thing I would add, because I think it's important that you hear literally from all of us, particularly entrepreneurs in the room, and I understand there are a lot of them in the room, you'll hear the same refrain, and that is, if you're really passionate about it, and you have a plan on how to solve a problem that you believe is a real problem, go do it. The one thing I would add to what's already been discussed is take this feedback as fuel. Try to understand this feedback that you're getting. Oh, don't go into that. That means nothing to me when I hear it, right? Because I'm going to ask why 5 times until I get to a real answer. And that's where the good stuff is. And that's the fodder you can use to help you build and mold your ultimate business model that will be successful. Now, what you're going to need to wade through all of that, what feels like resistance, but really is fuel, is passion. You're going to need an internal renewable source of energy, right? It's generally passion or commitment for an entrepreneur.
And I do think that one of the themes here too, in terms of thinking about that, is when Charles says that some of these are really huge markets, right? One of the things that's really fun about fintech is that they're huge markets with real problems. I read something at one point. I talked about the number of laundry delivery apps in the Bay Area. It was basically a bunch of guys who graduated from college and there was nobody around to do their laundry, and so they said, my biggest need is I need my laundry done. Like, it's a small market, right? These are big markets. Personal financial management. There's so many different areas within that you could talk about, and I do think that fuels the ability both eventually for financing and then exits. I'm going to ask one last question of you guys, the three of you who have companies. If you're willing to say, what do you think your most likely exit is, and what do you think the most likely time frame is? Who wants to go first?
It's funny. I'll say this. I had a call just before coming here with a 409A valuation firm. For those of you who don't know, 409A valuation firm is
That needs to be disrupted.
completely. And they just started as an industry in 2004. So 409A valuation, every time you do a financing, you're supposed to get a 409A valuation, which is this scientific valuation process, which is also known as made up. And
Worth the paper it's printed on.
It's used to size or identify what the strike price of your options are going to be. It's generally 20 to 50% of what you just did your round at market, right? The reason I bring all this up is because they ask you a question in order to help identify or rather value what your strike price is. And one of those questions is, when are you going to exit? It's an impossible question to answer. You don't know what the answer to that question is. And I think as an entrepreneur, if that's what's driving you, there's probably a good amount of doom in your future. The greatest entrepreneurs that I've been around, that I know, that I talk to, they are maniacally focused on building a great and lasting company, period. Everything else will fall into place after that if the focus is building a great and lasting company. And by the way, we know theoretically what the 3 exits are: IPO, sell, stay private and keep raising money, right? Or make money, or both.
Or go out of business.
Right. It's funny, I don't think about that one. So theoretically, there are 4 potential. The banking guy thinks about failing.
Yeah.
Oh, right, because he's trusting. He's trusting his infrastructure to these companies.
He's an investor.
Right?
That's true. You see it a lot more than we think about it in the future.
Right.
So that's fair. So 4 potential theoretical points. That's it. That's all you can really say. It's an academic exercise. Stay focused on building a great company is what I would say.
Well, before the guy who's actually had exit speaks, I think I'll just, in my view, whatever it is that you actually want to end up accomplishing, whether it's a IPO or whether it's a sale to another company, whatever it happens to be, it's almost irrelevant, because the steps in order to get there are literally identical. Because the second you start trying to position yourself, your business for a sale, or you start, thinking about that, then, all of a sudden, your business starts getting distracted, and then your focus is not on building your business. And that's exactly what's unattractive to any potential acquirer anyway. And so, in my view, it's like the steps in order to get there are exactly the same. And so it's almost irrelevant to kind of think about that until the very moment that there is such an opportunity.
So in my case, both prior companies were over $100 million in revenue. And so I want this to be bigger. This will be my last. So I want this to be bigger than anything that I've done prior combined. And
There we
then
go.
and then I'll be ready.
Excellent. Well, thank you very much, all of you. I really appreciate your candor and your time.